All right, stop scrolling for a second because something big just happened. In a single session, silver went from near $120 an ounce to 78, then ripped back more than 12% in one day to around $90. That's tens of billions of dollars of paper value erased and then partially resurrected in hours, not weeks. And this just happened as the US announced a $12 billion critical minerals stockpile and hosted a 50-nation minerals summit. Stay with me, because the real trigger here isn't what most headlines are saying. And if you understand this pattern, you'll spot it next time before the crowd does. Now, before I explain what caused this move, let me slow it down and teach you something most people miss. Markets don't just move on good news or bad news, they move on structure. Think of the market like a crowded theater with a few narrow exits. As long as everyone's calm, no problem. But when leverage builds up and someone yells fire, it's not opinions that matter, it's physics. Who can get out, how fast, and at what cost? Silver isn't just a metal, it's a leveraged paper market layered on top of a physical one. And when pressure hits that paper layer, price can move in ways that feel insane if you don't understand the plumbing. Here's what I mean by structure. When you trade silver, you're not usually buying physical bars. You're buying contracts, futures, options, all derivatives that represent silver. And those derivatives trade with leverage. That means you can control $10,000 worth of silver with maybe $1,500 in cash. Sounds great when it's working. But leverage cuts both ways. When price moves against you, that borrowed exposure becomes a liability. Fast. And here's the thing, exchanges know this. They watch volatility. When things get wild, they raise margin requirements. That's the amount of cash you need to hold your position. And when they raise those requirements, traders have a choice. Post more cash immediately or get liquidated. No negotiation, no grace period. So what does that tell us? It tells us that in highly leveraged markets, price isn't always about supply and demand in the traditional sense. Sometimes it's about who has cash and who doesn't. It's about who can hold and who gets forced out. And once that forced selling starts, it creates its own momentum. Price drops, which triggers more margin calls, which forces more selling, which drops price further. It's a cascade. And it doesn't care about fundamentals. It doesn't care if silver's needed for solar panels or strategic reserves. It's just math playing out in real time. If you're making sense of this so far, drop a comment and let me know, because this is the foundation for understanding what just happened and honestly, what's going to keep happening in markets like this. Now let me walk you through the actual sequence of events, because this is where theory meets reality. Silver had been running hot for weeks, flirting with $120 an ounce. That's not a level we see often. Momentum traders were piling in. Leverage was stacking up. Everyone was bullish. And then, overnight, something shifted. We got a sharp downdraft. Price started dropping fast. Within hours, it went from 120 to under 80. That's a 40% haircut in one session. Now, here's what kicks in at that moment. Exchanges see that volatility spike and they hike margin requirements. Maybe they go from 15% to 25% overnight. That means if you're holding positions, you suddenly need thousands more dollars in your account right now, or your broker liquidates you automatically. That's your primary driver. Forced liquidation. Traders who were perfectly happy holding at $115 suddenly don't have a choice. Their positions get sold into the market whether they like it or not. And when that selling hits, it overwhelms the bid. There aren't enough buyers willing to step in at 110 or 100 or 95. So price keeps falling until it finds a level where natural buyers finally show up. That level turned out to be around $78. That's where the cascade exhausted itself. That's where forced sellers ran out and physical buyers said, you know what, at 78, I'm buying every ounce I can get my hands on. But here's the secondary confirmation that makes this story even more interesting. Right near the lows, we started getting reports of major short positions being closed. Now, who holds massive short positions in silver? Usually it's commercial hedgers, banks, institutional players who've been betting against the rally or hedging physical exposure. When price traders like that, they can cover their shorts at a profit. They buy back at 78 what they sold at 100. That buying adds fuel to the bounce. And then here's where it gets wild. We also got reports of temporary system outages at key metals exchanges and banking infrastructure. Coincidence? Maybe. But here's what you need to understand. Those kinds of technical hiccups don't show up in quiet, healthy markets. They show up when stress is already extreme, when volume is spiking, when systems are getting hit with more orders than they're built to handle. So you've got forced selling driving price down. You've got short covering adding pressure on the way back up. And you've got infrastructure strain showing that this wasn't some calm, orderly repricing. This was chaos. Now, once that cascade hits bottom and shorts start covering, you don't get a gentle bounce. You get a snap. Liquidity returns, physical buyers pile in, momentum traders who got stopped out start re-entering. and suddenly you're up 12% in a day, going from 78 back to around $90. But here's the part that should make you nervous and excited at the same time. This happened just as governments started openly treating silver and other metals as strategic assets, not just commodities. The US announces a $12 billion critical minerals stockpile. They host a 50-nation summit on securing supply chains. That's policy demand showing up in real time. And when policy demand enters the picture, the game changes. Now let me zoom out with you for a second, because this exact playbook, we've seen it before. And when you see the same pattern repeat across different assets and different decades, that's when you know you're looking at something structural, not random. Let's go back to the 1970s. Oil back then was just an energy input. Sure, it mattered, but it traded like a commodity. Then 1973 hits. OPEC embargo. Suddenly oil isn't just about supply and demand. It's a geopolitical weapon. And what happened to the price? It didn't just spike and come back down. It reset higher for a decade. Every pullback found buyers at higher levels than before. Why? Because once governments started treating oil as strategic, once it became about national security and not just economics, the floor moved up. Volatility stayed high, sure, but the lows kept getting higher. Fast forward to 2008. Financial crisis. Central banks start printing money to save the system, and gold, which had been this boring relic that your grandparents talked about, suddenly becomes a balance sheet hedge. Central banks start buying, not selling, buying. And what happens? Gold goes from $700 an ounce to over $1,900 by 2011. Then it pulls back, but look at the structure. Every major dip finds support at higher levels. The lows in 2013 are higher than the highs in 2007. That's what happens when policy demand shows up. The asset doesn't trade the same way anymore. Or take rare earth elements in 2010. China announces export restrictions. Prices go absolutely vertical because suddenly everyone realizes these aren't just niche materials. They're strategic necessities for defense, technology, green energy. Prices spiked, then pulled back, but guess what? The floor stayed elevated. Mining companies that were worthless before stayed valuable after. Why? Because once something enters the strategic calculus, even when prices cool off, the underlying bid doesn't fully disappear. Same pattern we're seeing today with silver. Once policy demand shows up, once governments start stockpiling and summits are being held, and $12 billion programs are announced, you're not just trading a commodity anymore. You're trading a strategic asset. And strategic assets have different price dynamics. Volatility stays, maybe even increases, but the floor rises. Every time this condition appears, historically, this is what follows. The larger story here is this. Once policy demand shows up, price becomes political. It's not just about industrial use or investment demand. It's about what governments decide they need and how much they're willing to pay to secure it. Now let me be skeptical for a moment because I want you to hear independent thinking, not just hype. Is this all manipulation? Is every move some shadowy conspiracy? Let me be honest with you. Markets can be messy without being evil. Could there be large players positioning themselves to profit from this volatility? Yes. Could there be coordination between certain institutions or governments? Maybe. Could this entire move be orchestrated by some secret cabal controlling silver prices? Look, I'm not going to sit here and tell you that's impossible. But here's the thing. It doesn't actually matter for your purposes. Forced selling explains 90% of what you just saw. That's not conspiracy, that's mechanics. Infrastructure stress and well-timed short covering explain most of the rest. You don't need a villain to understand the lesson here. What matters is this. Can you identify when leverage is building? Can you spot when margin requirements might get hiked? Can you watch for policy signals that change the nature of demand? Those are the things you can control. Those are the things you can prepare for. Spending your energy on whether some bank in London is manipulating the market, that's not going to help you make better decisions. Focus on what you can observe and verify. Watch liquidity, watch leverage, watch policy signals. Those tell you more than outrage ever will. There are probably 3 types of people watching this right now. Some of you are long silver and you just survived a heart attack. You watched your position go from massive gains to underwater and back to break even or small profit, all in like 48 hours. Your stomach's still recovering. If that's you, let me tell you something. Your job right now isn't to celebrate the bounce. It's to ask yourself honestly whether your position size matches your risk tolerance. Because volatility like this, it's not going away. If you can't handle 40% drawdowns, and most people can't, then you need to size down. I don't care how bullish you are on the fundamentals. If the volatility is giving you panic attacks, you're positioned wrong. That's not weakness, that's self-awareness. And self-awareness keeps you in the game long term. Others of you are skeptical, maybe even bearish. You're thinking, this whole run-up was a blow-off top, this crash proves it, and the bounce is just a dead cat before it rolls over again. That's fair. That's a legitimate read. For you, the question isn't whether you're right or wrong about the big picture. The question is, what's your risk management look like? Because if you're short, or if you're sitting in cash, waiting to buy lower, you need levels. You need to know where you're wrong. So here's what I'd watch if I were in your shoes. If price holds 85 to 90 on the retest, that tells you the forced selling is done, and real buyers are defending that zone. That's a warning sign for bears. If it breaks back below 80 and heads towards 70, okay, maybe you were right and this is a bigger unwind. But you need those levels defined before the move happens, not after. Failed bounces tell a very different story than successful retests. Know which one you're seeing. And then there are those of you on the sidelines feeling like you missed everything. You didn't buy at 80, you're kicking yourself, and now at 90 you don't know if you're chasing or if it's still early. Here's the truth. You didn't miss the lesson. The lesson isn't about catching the exact bottom. The lesson is how these moves form. It's understanding that leverage builds, volatility spikes, forced selling happens, and then if the underlying story is still intact, you get a snapback. Next time this pattern sets up, whether it's silver or copper or lithium or whatever the next strategic metal is, you're not going to be reacting emotionally. You're going to be anticipating mechanically. Different paths for different people, but same principle applies to everyone. Structure first, emotion last. That's what separates people who survive these markets from people who get destroyed by them. So here's where I stand personally. I'm not blindly bullish and I'm not dismissive. I'm watching signals. Let me tell you what I'm personally watching. First, I'm watching whether silver holds that $85 to $90 zone, because that's where the forced selling exhausted itself. If it holds there on a retest, that tells me the worst is over structurally, and we're building a new base. Second, I'm watching $95 to $100. Reclaiming that area would confirm that the move isn't just a short covering bounce, it's real demand coming back in. It would show that despite the volatility, buyers are willing to pay up again. Third, I'm monitoring the $70 to $75 zone as the line in the sand. If we break back below that, it means something more fundamental broke, and I'd need to reassess the entire thesis. Based on my analysis, this move was mechanical, not emotional. It was structural, not narrative-driven, at least not primarily. The fundamental picture, as far as I can tell, hasn't changed. Governments are still talking about strategic stockpiles. Solar installations are still growing. Electronics demand is still there. Electric vehicles still need silver. The supply side is still constrained. None of that changed because price went from 120 to 78 and back to 90. What changed is that a bunch of leveraged traders got flushed out, and now we're resetting at a level where real buyers and real sellers can meet without forced liquidations distorting everything. If history rhymes, and it usually does, what happens next is this. Volatility stays high. You're going to see more of these moves, both directions. But the long-term floor rises. 6 months from now, a year from now, if this policy demand continues, if governments keep adding to reserves, if supply stays tight, the lows you see in future corrections will probably be higher than the lows we just saw. That's the pattern we've observed with oil, with gold, with rare earths. Once an asset enters the strategic category, the floor moves up even as volatility stays elevated. I'm not making a price prediction here. I'm not telling you silver's going to 200 or 300. I'm telling you the structure suggests the risk-reward has shifted. The downside probably has a floor that's higher than it used to be. The upside, well, that depends on a lot of factors we can't predict. Now, I'm not a financial advisor. This is not financial advice. Nothing I've said here is a recommendation to buy or sell anything. You need to do your own research. You need to make your own decisions based on your own risk tolerance and your own financial situation. What I'm giving you is framework. I'm giving you pattern recognition. I'm showing you how to watch these markets so you can make informed decisions for yourself. If you made it this far, you're the kind of person who doesn't just react to headlines. You're someone who wants to understand what's actually happening beneath the surface. That mentality, that's what separates successful traders and investors from everyone else. It's not about being smarter. It's about being more patient, more analytical, more willing to question the narrative and look at the mechanics. That will serve you well, not just in silver, but in every market you touch. If this was valuable, do me a favor. Share it with someone who needs to see it. Hit subscribe if you want more analysis like this where we break down the patterns instead of just reacting to the news. And stay sharp out there. The markets are giving us lessons every single day. The question is whether we're paying attention and learning from them. Think critically, verify what you hear, and make your own decisions. I'll see you in the next one.